Welcome to the deep dive. You've handed us a stack of sources on the Q2 FY26 performance and strategic roadmap of Dabur India Ltd, or Dare India Ltd as we'll call them. And we are jumping straight into what looks like a fascinating study in resilience.
It truly is. Our mission for you today is, well, to analyze how this massive FMCG company managed to not only survive a quarter defined by chaos. I mean, we're talking about weather-related disruptions, high inflation, and a major government policy earthquake, but to actually, thrive, we need to identify the levers they pulled.
And the reason we're calling it a puzzle right away is the core financial hook. Dare's consolidated revenue grew 5.4% year-on-year. Solid, but maybe not spectacular on its own. However, their operating profit grew 6.4%, and their profit after tax, the PTT, grew 6.5%. Both profit metrics grew faster than the top line.
That's the magic trick we have to unpack for you. When your costs are controlled so effectively that your profit growth outpaces your sales growth, it means the structure of the business is exceptionally tight. They found ways to generate margin expansion even while fighting serious market friction. We really need to start with the source of that friction, the policy earthquake.
Okay, let's unpack this with the biggest external factor. The government's landmark GST reform announcement. This was a move aimed at making products cheaper and increasing consumer purchasing power.
Right. Structurally, it's a huge win for Dare and the consumer. I mean, nearly 66% of Dare's entire portfolio benefited from rate reductions, dropping from the 12% or 18% GST brackets all the way down to 5%. Essentially, 86% of their products are now in that lower 5% tax bracket.
Wow, 86%. That includes staple categories like juices, toothpaste, hair oil, shampoos, glucose, and their proprietary Ayurvedic medicines. So products get cheaper, consumer demand should spike immediately, right? But here's the paradox that apparently tanked their September sales. Why did this, seemingly positive reform cause a short-term collapse?
It was a classic, if painful, trade disruption, driven by retailer psychology, really. When the government announces GST rate reductions, that means the final maximum retail price, the MRP of the product, is going to drop dramatically in some cases. So if you are a retailer or a distributor, why would you buy new stock from Dare at the higher old price only to be forced to sell it next month at the lower new MRP?
Okay. So the entire distribution chain, they anticipated the forthcoming lower prices and immediately held back on ordering in September. Just to avoid taking a massive inventory loss, they stopped primary sales pretty much dead in their tracks.
Exactly. This decision by the trade led to an estimated volume impact in Q2 of about 3 to 4%, which translates into roughly 100 crore in lost sales. It wasn't just a Q2 event either. The cleanup carried forward, impacting the first, say, 15, 16 days of October as they cleared out that high-priced inventory.
That's a powerful narrative, an intended positive policy causing immediate operational pain. But what's fascinating is how Dare plans to convert this short-term pain into a massive long-term gain. It all seems to come down to their strategy around low unit price, or LUP packs.
LUPs are crucial. They are the affordable entry point, contributing about 27% of their total business volume. Thanks to the GST reduction, Dare is strategically increasing the grammage in those LUP packs.
Right, so instead of dropping the 5 rupee price point, which is tough to do, probably impacts perception, they're giving the consumer, say, 10% more product for the same 5 rupees.
Precisely. It's an effective, untaxed consumer promotion proxy. In price-sensitive markets, especially rural ones, increasing the amount of product for the same price accelerates uptake far better than an outright price cut might. This is their volume lever for the future.
It makes perfect strategic sense. But we can't move on without addressing the second major issue that came up, a structural problem called the inverted GST duty structure. This sounds incredibly technical, but it sounds like a big deal.
It is, and we need to simplify it. Imagine you're running a bakery, okay? An inverted duty structure means the government charges you a higher sales tax, GST, on the ingredients, the flour, the sugar, the packaging. Then they charge you on the final product, the cookie, when you sell it.
Got it. So for Dare, their input tax on raw materials is estimated at 8% to 8.5%, but their weighted average output tax on the final product is only 6.5% to 7%.
Correct. This leaves an accumulated gap of maybe 1.25% to 1.5%. That difference is essentially working capital that gets stuck with the government as input credit. Dare highlighted that while they are implementing mitigation strategies, if the government doesn't step in to resolve this inversion, well, they'll eventually be forced to raise prices simply to neutralize that persistent tax gap. It's a real threat to the affordability they're trying to create, you see.
Yeah, that explains why the CFOs must be having nightmares. Okay, but let's transition from the structural issues to the domestic winners. Because despite all this turmoil, The India FMCG business grew 5.7%, and they gained market share across an astounding 95% of their portfolio. How did they pull this off while the GST disruption was happening?
Operational excellence and focusing on, well, structural consumer shifts. We need to zoom in on the categories that were running hot. Oral care was a massive engine. Toothpaste saw robust 14% growth and significant market share gains.
And the numbers reveal why. The herbal segment is booming, growing 5 times faster than non-herbal products. That's 10% versus 2%.
That massive gap confirms that the consumer shift toward natural and herbal products is not a fad. It's a permanent structural change, isn't it? Dare is perfectly positioned, leveraging their existing franchises like Da Red and Meswak, supported by successful regional campaigns like the Sudeshi campaign. They are capitalizing on a wave they helped create.
Moving into health and wellness, honey continues to be a leader, posting broad-based, volume-led growth of 28% year-on-year. And we're seeing the beginnings of premiumization here too, with variants like Sundar Bands and organic honey starting to gain traction.
And two other strong indicators of shifting consumer behavior. The Hajmola digestive franchise posted strong double-digit growth, showing increased consumption. And Honitis, their cough and cold remedy, jumped 28%. That latter number is a clear sign that monsoon demand was exceptionally strong, driving sales in those seasonal categories.
The home and personal care side also showed surprising operational strength. Hair oil grew ahead of the category and increased its market share substantially. Shampoo also held strong with high single-digit growth. And in home care, Odonil sustained double-digit growth, especially in gel pockets and aerosols, boosting their share in air fresheners.
These are quiet operational wins that add up quickly. But let's be balanced. The biggest domestic headwind outside of GST was in foods and beverages, specifically the real juices portfolio.
Yes, the monsoon weather issues and severe floods across several North Indian states clearly suppressed demand for cold beverages. When people are literally dealing with flood conditions, buying juice isn't exactly top of mind, I imagine.
Precisely. That said, Dare still managed to outperform the overall market and snatch market share even there. They gained ground in nectars and saw massive growth, 45% in their 100% active juices segment, heavily led by the sales of coconut water. So even in a category facing external threats, pockets of very rapid growth were identifiable.
So we've covered the operational resilience and the domestic winners. Let's address the international component, which also contributed meaningfully to that margin surprise.
Right. The international business reported 7.7% growth in INR terms, or a steady 5.5% in constant currency. This growth wasn't uniform, but it was incredibly fast in specific markets where they have established beachheads.
We're talking about high-octane growth figures, 37% in both the UK and Turkey, 12% in Dubai, 10% in Nigeria, and 13.4% in Bangladesh. These are clearly the primary focus zones for international expansion.
Though we should probably note the single international headwind, a 15% decline in Nepal due to geopolitical disturbances. They did suggest that the situation had begun to normalize toward the end of and immediately following the quarter with the formation of a new interim government, so that drag may ease.
Now, back to the core mystery. How did they get the bottom line to grow faster than the top line? We know price increases played a role, but the source documents point directly to a massive efficiency drive.
That's the key. This isn't just about inflation pass-through. They generated approximately 60 crores in cost savings just in the first half of the year through various efficiency initiatives. This highly disciplined cost structure allowed the operating profit and PK to shoot ahead of revenue growth. The expectation now is that margins will continue to hold up better than top-line growth for the full year, which is a sign of structural confidence.
And for you, the investor, they underscored that financial stability by declaring an interim dividend of Rs 2.75 per equity share, which is a 275% payout for the financial year. That's a strong signal in a choppy environment.
Absolutely. But the real story isn't just surviving Q2, it's the strategic roadmap moving forward. Dare is pursuing a dual growth strategy that is effectively betting on two entirely different consumer worlds.
Okay, the first pivot is volume, capturing the bottom of the pyramid in the rural markets. The data supports this focus. Rural growth is currently dwarfing urban growth. What was it, 8.5% rural versus 3.6% urban in the general FMCG market.
Yeah, that's right. Their strategy here is all about penetration and affordability, leveraging those LUP bundles we discussed with the grammage increases. They're also expanding distribution to reach more villages and actively upgrading their sub-stockers into full stockers to enhance logistics efficiency. This is a classic battle for market penetration focused squarely on volume.
The second pivot is the exact opposite, and it's meant to be their profit driver. driving premiumization in urban centers, explicitly targeting Gen Z and Gen Alpha consumers.
This is where tradition meets modernization. They're taking their traditional Ayurvedic expertise and packaging it in forms that appeal to a younger, urban, digital-savvy audience. Think Chyawanprash shifting away from just a large jar to multiple formats like convenient gummies and bars. They are also pushing high-margin, sophisticated products like shilajit resin and serums across their entire range: health, home, personal care.
And this urban premiumization push leads us directly to the biggest strategic announcement of the quarter: the launch of Dabur Ventures. This sounds like a serious commitment to securing that digital-first future.
It is a significant move. They have earmarked 500 crores for this venture fund over the next few years, and it's funded entirely by their massive balance sheet, which holds over 7,000 crores in cash. So they have the firepower.
And the purpose is very specific: taking minority or majority stakes in high-potential, new-age, digital-first businesses. They aren't going completely wild, though. The scope is strictly limited to their core areas and adjacencies: home and personal care, healthcare, wellness foods, and beverages.
Exactly. This isn't just about financial return, although they certainly expect superior returns higher than their current 6% to 7% treasury yields. It's really about accelerating their premiumization agenda. They are essentially buying companies that have already spent the time building a relationship and a digital identity with that Gen Z, Gen Alpha consumer cohort, allowing Dare to sort of jump the line.
So if we look ahead, what is the guidance for the near future? What are they telling the market?
While Dare is guiding for mid to high single-digit revenue growth in the second half of the year, that's backed by low to mid single-digit volume growth. But this hinges heavily on two variables. First, securing a strong winter season to boost demand for products like Chyawanprash and Honitis.
Right. And second, capitalizing on the fact that the GST disruption pushed primary sales loading, especially for those winter products, from Q2 into Q3. That delayed loading should provide a nice, clean boost to the immediate following quarter, shouldn't it?
Absolutely. The takeaway here is a highly effective, resilient operation that views macro disturbances not just as threats, but as opportunities to capture share and consolidate efficiencies, all while actively engineering their future consumer base through these dual strategies.
And that leads us to the final provocative thought for you to chew on. Dare is pursuing a strategy that relies heavily on two completely different consumer behaviors almost. They are simultaneously trying to capture high-volume rural growth through super affordable LUPs and investing 500 crores in high-margin, digital-first urban premium ventures. What does this dual, almost polarized focus imply about the stability or maybe the fragmentation of the overall Indian consumer base they're serving? And out of those targeted venture categories, HPC, healthcare, wellness foods, which segment do you think will yield the fastest return on that 500 crore venture capital? That's something to consider until the next deep dive.
Indeed. Thanks for joining us for this deep dive.